Yeah, but you can go on to what market capitalization is.
Yeah. That's really interesting. Like on the bear market. Yeah. So for market capitalization essentially is the total value of a company's outstanding shares. So what I mean as outstanding shares, that's another term. It means all the shares in the company that are currently held by shareholders. So all different shares that are held by people. That's what the market cap is. And you can also use the market cap to get the share price, essentially.
Right.
You know all the share, yeah. So you know number of shares outstanding, and you'd so essentially that's market capitalization. And for how you get that, you multiply the current share price by the outstanding shares. So
Right.
if this is the share price of Apple stock, and you know this is the total number of share outstanding, once you multiply those two together, you get what the market capitalization or market cap in short will be. You can easily get what the current share price is by a Google search. You can get the current share outstanding by looking at like their current maybe S1. So that's like when the company files their maybe quarterly reports, you see everything in the financial statements. So that's it essentially.
You might have heard, oh, Apple is worth 3 trillion. So that's their market cap that people refer to when, oh, Apple is worth blah blah blah. Tesla is worth, I don't know what they are worth right now, but yeah. So that's what they refer to when um that it is market cap that they refer to when they say, oh, they're just worth blah blah blah. So I mean, what else to
Yeah.
touch on? You mentioned listing, and I think you did a good job with that explanation. So on IPOs, right? That's what they call. Can you explain what IPOs are? Initial public offerings.
So an IPO, yeah, like you said, is an initial public offering, is the first time that a private company's shares are available for purchase, buying and selling by the public. So typically that process involves the company, meeting all the requirements of the exchange, publishing sending all the information, every nitty-gritty detail about their operations, their financials, their directors, everything about the company, and then they can make that available to the public. And the reason why companies, go public or list their shares or do an IPO is just to get more source of liquidity of capital to run the business. So they've typically, if it's a private company, the people who fund the operations are the owners. So it's just the private owners, be it institutional investors or private people who just invest in that company. But when you then go public, you are trying to get more capital, influx of capital from a wider range of people. So because there are more people that have access to buying the stock. So it helps
Right.
them to just get capital from the public,
Right. So they are raising funds
essentially.
in a way by selling parts of their shares to the public. A private company could be,
Yes.
private companies, B and Bade, we come together tomorrow and say, oh, we are starting a company and register it and we start doing our business. There are a lot of
Exactly.
regulations that we don't have to stick to because we are a private company. We choose to run it by on our own terms. And
Mm-hmm.
when a company decides to go public and have an IPO and list on any of the exchanges, they have this set rules and regulations or that they have to conform to for them to be listed as a
Yes.
public company. And once they are public, they are available to the public. People from outside can now participate of the earnings of the company. So if it goes up, people from
Mm-hmm.
outside, anybody who buys the company stock gets the profits of that. If we make money as a Big Body company, PLC, everybody else, outside that has bought the stock gets the profit as well. So we've touched
Yeah.
on a couple things. So when you are investing in stock, by the way, what are some things that you well, I think we've touched on things to look at, but what are some things that you say to avoid?
Yeah. So one thing you want to avoid is don't buy stock because everybody is buying it. I think that's so one, you need to develop your own conviction. So there's an acronym DYOR, do your own research to ensure that
Right.
you know what you're buying to the best of your ability because so you look through so you don't want to buy because everyone is buying. That's even the wrongest time to buy, in my opinion. So you want to develop your own personal conviction for why you are deciding to. It's just like you want to buy something. You want to. It's like think of say a stock is an asset. You get it's like you're buying a
Yeah.
farm or you're buying livestock or you're buying or you're buying a car, for instance, even though a car is a depreciating asset. So you need to ensure that you check everything that is within the car. I mean, what's the mileage on this car? Has it been involved in any accident? Does the brake work? How is the what's the fuel efficiency like? Everything that you typically do, or what you call due diligence, when you
Mm-hmm.
want to buy anything, when you want to buy a phone, like you check, oh, the seller, are they accredited? Are they credible? Do they get it from the right supplier? Or if you're buying it on the secondary market, how long have you been using it? Is it from the right source? All the different checks that you do, you need to do it on the stock as well. So you don't just like you don't make a decision to get something based off of everyone is doing it. You don't want to do that as well. That's kind of like the number one no of like investing in general. So you want to ensure that you've done your research to the best of your ability.
I mean, as much as the stock exchange or the stock market is a wealth maker in a sense, people have lost money too, or people lose money a lot of the time. And you don't
Yes,
want, if you're going to lose money, you want that to be off your own decisions, right? So you don't want it to be based on what you just read off the
absolutely.
internet or what Biya and Badi told you because they are not financial advisors. So,
But then
so
Billy
one
told you.
thing, yeah, because we are not financial advisors, and one of the greatest investors of all time, Warren Buffett, is first two rules of investing. Don't lose money, rule one, and rule two. Look at rule number
Lose
one,
money. Look at
and look at rule
one.
number. All right, thanks for listening, guys.